Good afternoon, everyone, and welcome. My name is Alisa Sladzinska, and I work for the City of Chicago Department of Business Affairs and Consumer Protection, BACP. Welcome to the BACP Business Education Workshop Webinar Series. We have adapted our regular business education workshops at City Hall into these webinars until further notice. On behalf of our Commissioner, Rosa Scarino, I want to inform you that business licenses can be processed online where applicable by visiting chicagobusinessdirect.org. And any websites or emails that I mention will be posted in the chat box, so you'll be able to reference them there. If you are part of the BACP Entrepreneur Certificate Program, you can get credit for joining this webinar by sending an email to bacpoutreach@cityofchicago.org. If you want to learn about the program, please visit chicago.gov/business-education. To help guide your business and employees during Chicago's reopening process, please visit chicago.gov/reopening. Also, BACP and the City of Chicago's Office of Emergency Management and Communications created Shy Biz Emergency Alerts. You can opt in to receive targeted emergency alerts for the business community. If you are interested, please visit chicago.gov/ShyBizAlerts. And we encourage attendees to ask questions. Please use the chat box and send your questions to all panelists. There will be a question and answer session at the end of the presentation. And today's webinar will be what you need to know about your business and taxes. It will be presented by Michael Mondronsik with the Internal Revenue Service, the IRS, and Michelle Coopers with Ladder Up. Welcome, Michelle and Michael.
Thank you, Lisa, and thank you, Michael, for co-presenting with me. And I want to thank the BACP for inviting both of us to take part in this wonderful webinar series to provide information for everyone. And I want to thank everyone in the audience who's taken time out of their day to watch this and learn something. So let's get started. I'm Michelle Kuipers. I'm the staff attorney at Ladder Up, and I work in the low-income tax clinic. Ladder Up, we're a nonprofit organization, and our mission is to provide hardworking people with free financial consulting resources to help our clients secure the opportunities they need to move up the economic ladder. At Ladder Up, we have a couple of ways that we do this. For one, we provide free tax preparation for individuals and families. We provide tax preparation for over 30,000 individuals and 50,000 families in the Chicago area. We also have a financial capabilities department that provides coaching and college workshops, one-on-one counseling, and that is actually going through an entire revamp right now, and we're looking for an exciting relaunch of that department, even bigger and better than ever, later this year. And then there's our low-income tax clinic, which is where I'm the staff attorney. At the low-income tax clinic, we assist taxpayers with disputes with the IRS and the Illinois Department of Revenue based on their income and family size. I also get to do educational events like this one and help people better understand some of the complexities that come with their taxes. So I'm very happy to be here. So the goal of this webinar is for you to be able to know when you need to file, identify your worker classification, prepare for an IRS audit, make quarterly estimated tax payments, and navigate the IRS website to find more information if you need it. So audits are not entirely scary if you are prepared. So what we want to do is be prepared for the possibility at this point. It becomes a lower stress situation if you have taken the right option, like taken the right steps. So let's start here. When do you need to file? Who needs to file taxes? As a self-employed individual or as a business owner, you must file pay your taxes if you had a net earnings from self-employment of at least $400. So even if you are not required to file your taxes, you should file if you had taxes withheld from a paycheck, if you have dependents, if you qualify for tax credits, or if you, in this year, 2020, if you did not receive either of the stimulus payments from the government earlier in 2020 or the upcoming one, and you would like to receive the recovery rebate credit. So it is beneficial to file in those circumstances. If you are a self-employed individual or thinking about starting a business, the first question asked is, what type of business entity do I want to be? There are lots of considerations when choosing a type of business entity. Taxes are only one of those, but it is something that you should think about depending on what your goals are for your business and how you're structured. These are up here on the screen are some of the most common types. A sole proprietorship is when someone is an unincorporated business and it's just by themselves. A partnership are when two or more persons join or carry a trade or business. Each one contributes money and labor and property and expects a share of the profits, but also shares in the losses in a partnership. A limited liability company is taxed like a partnership, but it is limited in its other legal liabilities. And this is something that needs to be registered with the Secretary of State in order to achieve. A corporation also needs to be registered, but a corporation is much more along the lines of when you want to sell stock or own stock in the company, and it comes with a whole separate set of rules and regulations. And S corporations are also sometimes called pass-through corporations, and it passes income, losses, and deductions and credits to its shareholders. So the first step is to choose the choice of business entity. The next step for self-employed individuals is to identify their worker classification, and if you are having a business, the worker classification of any workers that work underneath you. So the two primary types are an employee or an independent contractor. They both have pros and cons. An employee has some benefits in that they're automatically withheld the employment taxes of Medicare and Social Security is automatically withheld from paychecks and at the end of the year from taxes. That's not the case with independent contractors. Independent contractors have to pay self-employment tax, which is 15.3%, and that includes the share of Medicare and Social Security tax. The cons of being an employee, you get the nice automatic withholding, but your employer has a lot of control over your work methods and what you can do day to day. You can also not deduct unreimbursed employee business expenses if you're an employee. A self-employed person, an independent contractor, has some very nice benefits of controlling their day-to-day work, controlling their schedule, controlling the tools that they use. But on the flip side, they have to keep track of their own taxes. They have to pay that self-employment tax. And the best practice is for a self-employed individual to make quarterly estimated tax payments to avoid a large surprise balance on April 15th. And we're going to talk more about those quarterly estimated tax payments later in this presentation. Whether you qualify as an employee or an independent contractor, or whether you're people who work under you qualify as that, is based on some questions that you can ask yourself. Who has more control? You or your boss? You as the worker or your boss? Who buys the supplies? And can the worker reject jobs, or do they have to accept all jobs that are given to them by their boss? Let's take an example. Somebody who walks dogs, do they get to accept any clientele who come to do the dog walking? Do they have someone who tells them which jobs to take? Another example is a taxpayer who makes lamps. At first, it can sound like this might be an artist, and they can make whatever type of lamp that they would like. But on the other hand, if somebody works in a lamp factory, they're pretty clearly an employee because they have someone who is overseeing them and telling them which jobs to do. Worker classification is often determined by the type of tax form that you receive. So if you receive a W-2 form, you're very clearly an employee. If you receive a 1099 form, a 1099 MISC, you're an independent contractor. If you disagree with your categorization, if your employer sends you a 1099 when you think that you were an employee, the IRS has a form for that. It's the IRS SS8 form, SS-8. And you can submit that if you think you are not classified correctly. But there is a risk with sending in the SS8 form because your employer or your boss will find out that you've submitted that form. And so it is kind of something that you should weigh if you think you're classified incorrectly about the benefits, whether it's worth disrupting your job situation because your boss could fire you if you try and dispute. But it is something that needs to be weighed. So if you've figured out what type of business entity you are and you've figured out what your worker classifications are, the next step is preparing your business to be ready for an IRS audit if it ever comes. There are quite a few things that you can have prepared during your course of business that will help you be ready in the event of an audit. One is a business plan. The others are records like a business calendar, a logbook and income expenses, a mileage log, and then a business checking account and keeping your receipts and bills, all of which will be of assistance if an audit comes around, and we'll get more into those in just a second. As far as a business plan goes, a business plan is really useful to determine at the start of your business what is going to be deductible and what is not, i.e. what is a business expense and what is a personal expense. The more records you keep in this regard, it's going to be less stressful if an audit ever comes because records all together will tell a truthful story of how you run your business, what money you made, what money you spent, what trips you went on, all sorts of things like that. If anyone comes along who is a third-party person, like an IRS auditor, they'll be able to put together the complete picture of your business from those records. If you don't keep records at the time of the event, or if you keep messy records, there's much more potential for mistake and there's potential for forgetting because the best time to log what you're doing is while you're doing it. For business plans, there's a resource called score.org, SCORE.org, and that's a good place to help take a look at the types of business plans and find a business mentor who can help with a business plan, depending on how you intend to make money. So let's look at an example case of some of these records in more depth. Our example case here is Mark. He is a massage therapist and he's a sole proprietorship, which as we learned means he owns an unincorporated business by himself. So let's see how Mark keeps his records for his massage therapy business. And while we're looking through, let's look as an example of records, but let's also keep in mind that Mark might have an audit coming. And so let's put our auditor hats on. Here is Mark, we see Mark's business calendar. The most important parts to keep in a business calendar are records of appointments that you might have, including who was at the appointment, or in the case of his June 3rd conference, American Massage Conference, what the appointment was, where the appointment was, and why the appointment happened. So we can see in his logbook, we have a conference, but we also have logs of the massages he gives. We have the initials of the client, the length that the massages, the type of the massages, and where it took place. In the case of the one on June 5th, it took place in Mark's studio. So keeping a calendar like this is a great first step. Next, we see a good example of Mark's logbook of income and expenses. And I know this looks terribly overwhelming. There's so much here. But if you look on the left, you see the date line. There's only a few entries per day. So it's once you keep these, as long as it is a daily routine, it's not going to be that overwhelming. So we see here on the logbook, we keep the date, the description of what the income and expense was, and the total expense or income. Over here on the right side where it says totals, think about that much more as the deductible amount of the income or expense as far as Mark's taxes are going. The logbook that you keep should match up with your calendar, which is why we include the who, the what, and the why, and the where. This should all match up so that everything flows together if looked at as a whole by an independent person. Now, with our auditor hats on, there is a mistake in this logbook. Down on the date of 6/6, this is line 124 on the left, Mark has bought a bottle of champagne for an Aloha printing company, and this is a gift. The mistake here is that the max deductible amount for gifts is actually $25. So we'll see how this comes to a head for Mark, but it is important to keep these logbooks even if there will be a mistake involved in them. The next thing we'll look at is Mark's mileage log. So a mileage log is a great thing to keep in your car, or you can do something on your phone. You can do a mileage app. It records the miles that you drive for business. The standard deductible mileage rate is in 2020 is 57.5 cents per mile. So it is very important to log your business travel. And here we see in Mark's logbook, he's got the date of the travel, the destination or the purpose of the travel, and then the odometer on his car when he started and when he ended. And he also includes whether the travel was for business or personal for his own records. So let's look a little bit more in detail about mileage and what type of travel can be claimed. So say Mark has a busy day, he has to see 2 clients and approve some proofs at Aloha Printing. Let's look at whether and how the travel will be deductible. First, there is a defined concept of a commute. I know you've heard this, but the commute has meaning for tax purposes. The commute is the first and last leg of your trip, i.e. your initial trip to work and your final trip home from work. Since the commute exists for employees who can't deduct travel and for self-employed individuals can't deduct their commute. So it takes a little of keeping track of, if you're keeping track of your miles, to define what your commute is. So for example here, Mark travels from his home on the left to his studio, and then from his studio back to his home. That's just a commute, and he can't deduct those miles. But Mark has some appointments. So in the middle, if Mark starts at his home and studio, and it's combined, and then he goes to his client, JR, and then he travels from JR to his next appointment at RB, and then he travels to his next appointment at Aloha Printing, and then he travels back to his studio. Those are deductible miles because they were all done for business purposes, and they all originated at Mark's studio, which in this case is also his house. On the right, if we have Mark at his house, and his house is not his studio, and he travels to his client JR, that's his first trip of the day, so that counts as his commute. His next trip from JR to RB, his next appointment, that is a deductible expense because that's business travel and it's no longer his commute. After that appointment, if he goes to his printing location to approve the proofs, that's still business travel, so that's deductible. And finally, he goes from the printing place back to his house. That is not deductible. It's the last trip of the day, so it's his commute. This is really important for self-employed individuals who are rideshare. I know rideshare is becoming more and more common. People who drive for Uber or Lyft or something like that. The same thing applies for rideshare. So if you are driving for Uber and you have your first trip of the day, you leave the house and you're driving to your first pickup, that counts as your commute. After you pick that person up, taking them to their destination and driving from there to the next passenger, that is all deductible miles. After you drop off your last passenger and you head back home, that's your commute, and it's not deductible miles anymore. If you have a home office, like in the second example with Mark, your home office commute, or if you're working from home and you're self-employed, travel from your bed to your kitchen or bed to your desk or wherever you do your work, that's your commute. So the next thing that is so important with audit keeping, record keeping, is keeping your receipts. So right here we have the receipt from that champagne that we mentioned. Mark spent $90 on champagne, intending it as a gift to a business that he was working with. And we know that the deductible gift limit is 25, so that is not going to be allowed. But it's a good thing that Mark kept it so that he knows what that was in the event that there is an IRS audit. It's a very good idea to keep receipts for large items or questionable items so that you can prove the amount and the time that it was purchased. It's also a good idea to have a business bank account and to deposit all cash into the business bank account so you have a clear record of your total income. This just makes things a lot easier in the end. So with this, Mark, and hopefully the audience here is all prepared and knows what types of records that they should be keeping in the course of their business to prepare for an audit. And I will hand it off to Michael, my IRS co-presenter, to discuss what happens with the audit from the IRS perspective.
Thank you, Michelle. Can everyone hear me?
Yes, we can hear you, Michael.
Thank you. What I'm going to speak about now are well, we'll start here on this, this slide. We're going to talk about red flags for the IRS. What does the IRS look for when selecting tax returns for audits? Trust us, the IRS audits are not random. There has to be a potential to collect more taxes. It's got to be there before the IRS is going to dedicate resources to an audit. So what the IRS does is to compare average expenses from our statistics of all of the audits that we do and all the returns that we see, and look for overstated deductions. And I'll go over how we come up with some of these statistics later. There's also certain deductions that we have found that are areas for abuse. And let's look at a few of those right now. We're going to look at meal and travel expenses, business use of vehicle, and the home office deduction. So let's start with meal and travel expenses. Well, for me, these are business meals and business travel that we're talking about. So for meals, what the IRS looks at is to try to ensure in an audit that no personal expenses are being deducted. And when we look at travel, we're looking at the business owner being able to deduct business-related travel and meal expenses if they are traveling out of town being the key. There also has to be a business purpose for the trip. So if we undertake an audit looking at these expenses, we're looking for personal expenses and the purpose of the trip. An example of an issue that we find is that a business owner will deduct the total cost of a business trip, where he or she brought their spouse and children along. The business portion is a valid expense associated with the owner. But as you can guess, any expenses associated with the spouse and the children, they cannot be deducted as a business expense. So one important thing that Michelle has imparted upon us in her earlier presentation, and I'll echo that here, it's of great interest to the IRS to see if we're going to be looking to see your receipts and your ledgers, where you're keeping your records, your business records. So it is vitally important that you keep the receipts and you keep a contemporaneous ledger of your business transactions. You can even scan these receipts electronically if you want to keep them in an electronic format. That's not a problem. For meal expenses, you should jot down who was at the meal. Remember, it needs to be a meal, business-related meal. Jot down who was there to substantiate the business purpose. Some of the things you'll want to jot down are the client's name, the business discussion, because without proper documentation, deductions will be lost. Now let's talk about the business use of a vehicle. If a business owner claims 100% business use of an automobile, this is something that the IRS is going to take a closer look at. On the surface, 100% business use of a vehicle doesn't seem quite right. As we noted previously, keep detailed mileage logs and precise calendar entries for the purpose of every business trip in which you use that vehicle. Now, when you deduct car expenses associated with the business, you can take either the actual business use expense of the vehicle, or there is a standard mileage option. Michelle gave you the standard mileage rate for 2020 earlier. And you can use whichever method brings you to a higher deduction, as long as they're all legitimate expenses. Now, for actual expenses, you'll include expenses like the car's depreciation, repairs, gas, oil changes, tolls. Keep those receipts. Another option for deducting the car expense, again, is to use the standard mileage method. For this method, you would keep a running ledger of your business miles and then apply that standard mileage rate to the business miles. In the ledger, make sure you're identifying what each trip was for. So in the first year of your business, you should keep both actual auto business expenses and that standard mileage log to see which one is higher. When you can decide the method you can use at that point, there is an option to take the standard mileage in the first year, but then in later years, you can switch to the actual expenses if you find it more beneficial. However, that's the only way you can change the method once it's established. Now let's talk about the home office deduction. If you qualify, you can deduct the business use percentage of your apartment rent, real estate taxes, utilities, phone bills, insurance, and other costs that are allocated to the home office. And just like with the auto business expense, there's two ways you can identify the home office deduction expense. There's the option of taking the simplified option, where you use a standard rate per square foot of home office space times the allowable square feet to get the maximum deduction using that option. Or you can take an actual cost approach, where you determine the percentage of the space used exclusively for the business, and then you take that percentage to the rent or the mortgage interest, depreciation, real estate taxes, utilities, insurance, and other costs associated with your home. With this method, you'll need to keep the receipts. To take advantage of this tax benefit, you must use the space exclusively and regularly as your principal place of business. Now, exclusive use means that a specific area of the home is used only for trade or business, and it does not double as, say, a family room, a guest bedroom, or a child's playroom. However, there is an exception for a childcare business, as those businesses are allowed more space since the children can use several areas of the home. Now, there is extra scrutiny in this area, and if you're audited, we will go out and visit your home office to inspect it. Now, lastly, you should know that if you own your own home and take a deduction, then when you sell it, you'll have to pay taxes on the depreciation that you took as a part of the home office expense. But it's only the depreciation portion where you'll have to pay taxes on. Let's talk about cash-based businesses for a minute. Now, small business owners and cash-intensive businesses, such as bars, hair salons, and restaurants, also have a high likelihood of being audited. Excuse me. First, in an audit, the IRS looks for an audit trail for the money. So it'll look for bank account, foreign bank account, investment. Now, that's looking on the income side, looking to see where income may have been deposited. But we're also going to look at the expense side. The reason we do that is because while a small business owner may not always identify all the income that they should report, it's more than likely that the expenses, they will always take the deductions and the expenses. So we will look at that, both sides of the equation, both the revenue and the expenses. Now, another way that we find unreported income is through cash transaction reports, where cash is used to make purchases over $10,000. When cash is used to make these types of transactions, the business accepting the cash should be filing a Form 8300, which is reported to the IRS. The IRS uses this information in its audits. And another way that the IRS looks for business income and making sure that it's being reported is through the reporting done on a Form 1099-K. These are the forms that are submitted to the IRS by the credit card companies, PayPals, other third-party payers, where a business owner will sell something, accept as payment for that a credit card, and that credit card information is reported by the credit card companies to the IRS. The IRS will compare what it receives against what is being reported on the return. Now, a couple of pieces of information about audit flags and the statistics that the IRS uses when it's doing its audits. Now, every few years, the IRS conducts intense audits, which are known as national research projects. These projects help us update our statistics that we used when we look at tax returns as possible audit returns. Now, normally under an audit, we may select only a few items on that return to verify. But in these national research project audits, they're much more intense, and we verify everything on the return that's been selected. The reason why it's important is because it goes into our statistics, and we need those statistics to be correct. And these statistics are used to select tax returns for audits. And we keep statistics by area, by business type, and many, many more types of classifications. If we could go to the next slide. We're going to talk now about a business versus a hobby, making that distinction. What is the difference? Well, you've got to report any income you earn from a hobby. However, as you must with a business. However, in a hobby, expenses that you can deduct are limited to the hobby income. So you're not able to take a loss from a hobby, whereas in a business, losses can be recorded. On the other hand, if you're a bona fide business, as I just mentioned, you can take losses. As a general rule of thumb, to determine if the activity is a business, we look at the activity and whether it generates a profit 3 out of 5 years. If that's the case, the law presumes that you're in a business to make a profit. We do look at these on a case-by-case basis, the activities on a case-by-case basis, and we look at all the facts. Other ways to determine if the activity is a business is that we will look at how much time was spent on a consistent basis with the activity. How was the activity marketed? Is it run like a business? Or is it just word of mouth where the individual operating the activity is not really actively looking for more business? Does the activity have a website? Or are you still trying to figure out what to do with the activity? Does the person operating the activity have an education and knowledge in the area? Are they expecting a profit from it? Are they depending on it for their living, to meet their living expenses? Through all this information, we'll look at it, try to get an understanding of how serious the individual is about it, in determining whether or not it's a business or a hobby. Let's go to the next slide. Michelle mentioned this earlier, but self-employed individuals generally must pay self-employment tax as well as income tax on their net profit. Now, as an employee, I worked for the IRS, and each payday, the IRS takes out of my pay Social Security and Medicare tax. In addition, the IRS pays Social Security tax so that I contribute and also the IRS contributes. That is what is happening with self-employment tax. The self-employed individual, through the self-employment tax, is paying both portions of the Social Security and Medicare tax that I as an employee pay half and my employer pays the other half. Before you can determine if you're subject to self-employment and income tax, of course, you'll have to figure the activity, the business's net profit or loss. If you have a profit of $400 or more, you'll need to file a return for the business and pay self-employment and income tax. Now, if you expect to owe more than $1,000 when you file that business return, you should be making estimated tax payments during the year. These payments are made 4 times during the year, on the 15th of April, 15th of June, 15th of September, and the 15th of January. Self-employed individuals would use Form 1040-ES to compute those estimated tax payments. If you are a corporation, and I'm not talking about an LLC or an S corporation, you would use the Form 1120-W, and all others would use the Form 1040-ES. It's very important to make these payments. Why is it? And why is it important to keep current with the tax payments? I'll give you an example. A business owner didn't know about making estimated tax payment until it was too late. She had spent the profits of her business during the year rather than making those estimated tax payments. And when it comes time and the understanding, it becomes apparent that taxes are due and that the taxes really should have been paid out of those profits that were instead spent elsewhere, there's going to be interest added on to the tax due. There's going to be penalties, and it's going to be a situation where payments that should have been made haven't been made, and may have to scramble, and it may have a negative impact on the business. So make sure that tax payments are paid as they are required to be paid to protect your business, protect your hard work that you've put into that business. Now, let's go to the next slide. There are a lot of great resources that are available for you on irs.gov as a self-employed and a possible self-employed or small business owner. Just tremendous resources to help you understand your responsibilities as a small business owner, your tax responsibilities, federal tax. So let's take a look. Here's the irs.gov main page. If we go to the next slide, as I said, there are resources specifically dedicated to businesses and self-employed individuals that will take you through the steps and the processes and give you an understanding of what, as a small business owner, what your responsibilities are. And here you see in the middle of that screenshot of the irs.gov, the business and self-employed link. If we go to the next slide, there's specifically tax information for small businesses. And one of the really great resources is there under the circle, the Small Business and Self-Employed Tax Center. It is a one-stop shop for everything that you need to know and understand about what we've talked about here today and much, much more. So this is a great resource. Let's go to the next slide. And you can see this is the Small Business Self-Employed Tax Center. All the links that are available there, and there's information on what we've talked about today, the types of business structure, the types of records that you should keep. In addition, there's also information that you can use On another website that's not being shown here, there is also a website which is irsvideos.gov, irsvideos.gov. And in there is what we call a virtual small business tax workshop. And there are 9 lessons that will take you through the steps of becoming a small business owner, setting up the reporting procedures and processes that you need to keep your records, give you an understanding of the types of taxes that you need to pay. In addition, it's available 24 hours a day, 7 days a week, and you can stop a lesson, come right back to it. It's available. And again, all this information is free. So it is available and free for you. Let's go on to the next slide, and we're going to talk about coronavirus tax relief that's available not only for the year 2020, but also it's been extended in many cases for the year 2021. In 2020, there were payroll tax credits and a payroll tax deferral as part of the IRS COVID-19 relief for business. What does that mean? A payroll tax credit, laws were put in place, tax laws were put in place in the effort to provide especially small business tax owners with cash to help them get through the COVID-19 period. Payroll tax credits are tax credits that reduce your tax dollar for dollar, could even provide a refund, all by trying to allow small business owners to keep their employees on the payroll. In addition, a payroll tax deferral was put in place, and that allows small business owners to keep the payroll taxes that they usually pay to the IRS. Now, the key word is deferral. They're allowed to keep the taxes rather than pay them over to the IRS. Again, trying to help those businesses get through the COVID-19 period. But again, it's a deferral. Those payroll taxes will eventually need to be repaid or paid over to the IRS, which is occurring in stages in the next year or two. Now, there is specific detailed information about what I've just scratched the surface on in regards to this coronavirus tax relief on the web page that you're seeing there on the slide. That will give you great details on what I'm talking about. It'll also provide frequently asked questions, which are another great resource to help you understand the law that's put in place to help small business owners and other business owners through this COVID-19 period. So go to irs.gov/coronavirus and you can get that information too. With that, if we go to the next slide, I've finished my portion of the presentation, and so I'll turn it back over and see if there are any questions.
Thank you both for a really good presentation and walking us through. It's definitely been an important time for businesses and taxes, so thank you so much to both of you. And we do have some questions coming through. If you have not sent your question in yet, you can do so in the chat box and just send it to all panelists. And Michael, just a quick confirmation, the website you mentioned, was it irsvideos.org or what was that website you mentioned?
It is IRS videos, so that's IRSVIDEOS.gov. IRSvideos.gov.
And I just posted that link in the chat box for everyone. A question came in of how long should you keep receipts?
Well, the law says that the IRS has 3 years to do an audit unless there is fraud involved. So in general, 3 years. If you have assets, say a building that you're depreciating over many more years, depreciating the cost, you should keep those records as long as you have the asset.
And Michelle, you talked about logging in your commutes and travels. This person's saying if they don't drive, are they able to log public transit use?
Yeah, that's a great question. If you don't drive and you take public transit, the fare that you pay, like the train fare or the bus fare, that should still be deductible as travel expense. What I would recommend is instead of keeping a logbook of miles, you keep a logbook that designates where you're going and how you're getting there. For example, you're going to take the red line and then you have to take the 147 to get where you're going. So you do train and bus. So that way you know that you paid the train fare and you paid a transfer fee to get onto the bus. And so you keep your logbook that way. One good idea for that is I know in Chicago, the Ventra website allows you to see previous trips, but it doesn't necessarily tell you where you were going, which is why your own logbook is going to be helpful. You could also get a Ventra card that is just for your business use and then a Ventra card that's just for your personal use. So that way you can keep those very separate and you can see exactly the business expenses versus exactly the personal expenses. But yes, you should be able to deduct things like train fare for travel expense.
Thank you. A question is about quarterly. It was mentioned that quarterly was 6/15 and 9/15, and this person's questioning, wouldn't it be 1/15, 4/15, 7/15, and 10/15?
Well, the information I provided is the correct information.
Mm-hmm. Next question is, this person sells t-shirts. They know they need to pay sales tax to the state. Will they also need to pay a self-employment tax and income tax?
Yeah, Michael can correct me if I'm wrong here, but as far as I know, if you're making t-shirts and you're a self-employed individual doing that, you're not working for anyone else, then yeah, you will have to pay self-employment tax and income tax.
Next question is, I'm starting a business, but they haven't launched their business yet, so there is no income or revenue coming. They have their LLC number, EIN, tax number, and they opened a business bank account. When should they start paying tax and filing all the IRS tax forms?
Well, as the business is recording activity, that's when you should start reporting.
Next question. I opened an S Corp last December and started to get paid on January 2021. Writing myself a monthly salary and wanted to understand when to file federal and state taxes, especially for withholding taxes.
Michelle, did you want to take that? Or?
Let me check some of my documents, and I know, Elisa, I have a little informational handout that we talked about maybe sending to people after the presentation. Is that still an option?
Absolutely. So there is the handout part of this webinar. And to all of our attendees of this webinar, we will send a follow-up email probably tomorrow. You'll get it in your inbox. You don't need to send us an email. We already have your emails. Another question is, if you have a LLC, can you file along with your 1040?
Can you file the LLC return along with your 1040? Yes, you'll be filing both for the LLC and the 1040.
Okay. Question is, how many years back would the IRS go in for an audit? And yeah, that's the question. Sorry.
I think Michael mentioned earlier that the IRS, I think Michael mentioned the IRS will go for 3 years unless there's fraud suspected on audit.
Yes.
Person's asking, I'm working as an IT consultant through my S Corp company, and this year we're not going, but if I need to drive 27 miles one way to the client site every day by my personal car to work, in this case, is mileage considered an expense?
Michelle, I'll let you take that.
Sure. As far as I know, if you are having to drive to the client site every day for work repeatedly, but that's the only trip that you're going to take, it's an unfortunate situation where that's going to be your commute. So your first trip to the client site, 27 miles, and then your first trip home from the client site, or your last trip home from the client site, that's going to be considered your commute, even if it is very far.
Can you briefly describe again the difference between a Schedule E and a Schedule C?
The Schedule C is for the self-employed person recording the tax activity, recording the income and the expenses for tax purposes on that Schedule C. Schedule E is, I know personally, I file a Schedule E as someone who, for example, rents out as a rental property and rents out that property. There are other uses of Schedule E, but that's the one that comes to the top of my head.
Question is, if I use a PayPal account to collect payments, Should I be moving that back to my checking account for records?
I think that best practices there are going to be if you're using a PayPal account and you're running your business, taking payments through that PayPal account, the best practice is going to be to transfer that money from the PayPal account to your business checking account. So that way, if you make income through the business through any other means, there is a full collection of your sources of income in that business income account. And I know that you might only be making income through PayPal at the moment, but it is good to set up the standard for your business that all the business income from any source, PayPal or otherwise, goes into the business checking. So that way, if you expand to like Venmo or something, you will still have that standard for your business that it all goes into the business checking and then goes out from there.
So Michelle, would you say no matter what type of payment form a company's using, they should still have a banking check or a bank check account, correct?
Yes, correct.
If either of you can answer, this person is an S Corp, the single owner and employee, and they're paying the healthcare premiums from their salary and wants to know if healthcare premiums are an expense or not.
I don't know if Michael might have more information on this, but from my experience, healthcare premiums are not a business expense.
I guess I would, and I'd be happy to give out my email address. There are a lot of different scenarios and circumstances. I prefer to take the question and get specifics about his or her situation and get an answer back to them that way.
And that's actually a good point, Michael. For some of the questions coming in that are extremely scenario specific, we do recommend reaching out either to Ladder Up or Michael with the IRS. Michelle, I do see you have the website for Ladder Up on the screen right now, which is goladderup.org. And then Michael, what do you recommend for someone needing to reach out to the IRS? What's a good resource for them?
Well, IRS.gov, as we've been talking about today, but I can also give you my email address. And what I would do, if you can be, and don't provide any personally identifiable information, names, social security numbers, things like that. Provide a description of the question and the scenario and the circumstance and situation that you would like some information on, and I can find the IRS resource that will help you get the information that you're looking for. Now, in addition, you can call the IRS hotline, which is I believe 800-829-1040, and that is information for typically individual taxpayers. We also have hotlines where you can call in and ask questions on business tax questions, and I don't have that memorized off the top of my head, but I'd be happy to get that resource for you too. So if someone wanted to get a hold of me, you could send me an email at Michael, M-I-C-H-A-E-L .j.Mudroncic, which is M-U-D-R-O-N-C-I-K at irs.gov.
And that email, phone number, and website was provided in the chat box. Once again, for those super specific questions, just reach out to the IRS that way. And like Michael mentioned, I want to emphasize to not share your personal information in the email, just a description of your question. And we do have time for a few more questions, so we'll carry on. Question is, are supplies needed for your business, for example, products, cleaning supplies, etc., able to be deducted?
Yes, if they're used for a business purpose.
Yes, I agree. I agree.
Question is, do you still have to pay taxes on income that is paid through your business to you if you also paid taxes on the income from the business?
Well, it depends. This is more of a, again, a specific scenario. So I would request that they, depending on the type of business they have, to get in touch with me. You can send me an email and I'll be happy to get a response to you.
Perfect. Next question is, if our company is incorporated in Illinois, but we conduct business in additional states, will I need to file taxes in all states?
I think this is going to be a question that you're going to have to look at the states where you do business. I know a lot of states, if you're they call it a foreign business, I think. Usually, if you're a foreign business to the state and you're conducting business within the state, you usually have to register with their Secretary of State also. And I would just urge you to look into their website resources, their departments of revenue, and see what the requirements are on a state-by-state basis.
And we will end with this question. As a small business owner, will I need to pay 3 types of taxes? State, federal, and self-employment tax, is that correct?
Well, again, I think this is all dependent on how your the business structure, where you're located. There might be local taxes too. You would need to look at all of that. Michelle, I don't. Do you have anything else?
I just want to clarify that self-employment tax is a federal tax. So making the distinction as state and federal, and then self-employment's a subsection of federal. So when you have a business, your umbrella of taxes you have to pay expands, right? So for example, the person who sold the t-shirts, they have to pay their own income tax, personal income tax, but they also have to pay state sales tax for the sale of the product. And they have to pay self-employment tax as part of their federal tax. So it is very case by case specific, but there may be more taxes under that umbrella of federal or the umbrella of state that you need to know about as somebody who owns a business. Does that make sense?
Yep. Perfect. Well, I want to thank both of you for sharing your expertise with us this afternoon. For those who still have scenario-specific questions, please feel free to contact Ladder Up or the IRS. Both contact information and website information has been posted in the chat box. And like we mentioned, there is a handout, part of this presentation, that will be emailed to all of our attendees. So be on the lookout for that. With that, we are concluding. Michelle and Michael, do you have any final words for our attendees?
Just thank you so much, everyone, for your great questions and for your attention. I know that we've kept, from the start of this presentation to the end of it, we've kept a lot of attendees around. So I'm really thankful for your interest and for the BACP letting us present today.
Yes, thank you very much for allowing us to present, and really appreciate the opportunity. And again, if I could be of assistance, get in contact with me.
Great. Thank you both again for joining us. And thank you, like Michelle said, to our attendees for joining this webinar. And with that, we are concluding. Thank you everyone for joining, and have a good rest of your day. Thank you.